about what's happening in the markets, we are joined by Dilip Bhatt, Joint Managing Director at Prabhudas Lilladher. He's joining us from Mumbai. Thank you, Mr. Bhatt, for speaking with us at NDTV Profit. Now, the markets seem to be quite weak. We've seen that in the recent past, they've reacted negatively to good news, be it the insurance bill passage in Parliament or be it the surprise rate cut by the RBI. What does this show about the strength of the market? Are we going to be weaker for the markets? Will we head lower?
Well, I think you summed up very well. Actually, markets have really sold off quite a bit on all the positive news that came about. So I think markets really has had a very good run up. Now, probably they're still looking for some further triggers which can drive it. And as we run into the result season, I think more or less we are reconciled to the fact that this fourth quarter results are going to be pretty anemic overall. And I think it will be just bearing a few companies in there. Most of them should not be any great thing to talk about. So I think the other part which is really worrying the market at the moment is that now that the budget is gone, that the rate cut has happened, but yet on the ground level there are no immediate signs of any great recovery happening, notwithstanding the fact that we are still talking about a certain GDP number. So I think that is certainly worrying a lot of people on the ground and especially in the markets. So all plus the year-end factor, all those things are weighing. But my own sense is that the markets may not come down anything significant from the current levels, maybe 150, 200 points maximum on Nifty from the current levels. It will take a good support. I think going forward, maybe it will remain a little range bound, maybe up to 8,900 to 9,000. Maybe a little over enthusiasm may push it beyond 9,000. But otherwise, I think markets will still trade in that range, still waiting for further confirmation about the overall economy in the positive direction.
Right, since you did not really list for us many positive triggers, what stops the markets from going lower? You said many of the positive triggers are behind us, be it the budget, be it rate cuts. The expectation is that the RBI will not do much, will be on hold in the April meeting. So what's going to, support the market? You expect even the earnings to be weak?
So my own reasoning of this entire situation is that India is in a very sweet spot at the moment as compared to any of the emerging markets. So, within India, if you look at the markets, one continues to buy levers, one continues to buy ITC or HDFC Bank. It doesn't matter what is, how expensive they are. So I think similarly, as an analogy to that, India also is placed in a similar position as compared to any of the world economies. India probably, the way the oil prices come off, I think, and with a very strong government at the center, the optimism is all pervasive. When it translates into action, we don't know. So I think India will look expensive. Valuations, prices will be significantly ahead of valuations. But yet, I think India will remain a good place to invest for the international investors. So that gives me a good confidence that overall, I don't see much correction happening on the downside unless and until there is a major panic somewhere overall. And even if you were to just compare internationally, despite the fact that Europe is in doldrums, Japan is in doldrums, those markets are hitting a new high. So overall, I think markets are awash with liquidity, which may come into question mark once the rate hike starts happening. But overall, I don't think that there is such a great threat to the Indian markets. And overall, I think the downside appears to be a little more capped.
Right, so Mr. Bhatt, you're saying that the fundamentals are not likely to improve very much in the near term, but liquidity is going to be the cushion for our markets. But, the money that has come in also has gone into sectors where, there was earnings visibility and they're pretty expensive. Do you think this is going to continue, or are we going to see some money flowing into other sectors that are, likely to do well should growth revival happen?
So, the way we have seen the money flowing in at the moment, it has been pretty discriminate in the sense that it has not been trying to chase each and every stock which is there in the market. and it's not a broad based. Even today, in spite of the fact that index is at 8,600, 8,500 to 600 Nifty, we still see that the valuation gap between the front lines and the other stocks have only increased over the time. So it does mean that though they are very expensive, people are still chasing quality, mainly out of defense and also hoping that they will provide a good resilience to the portfolio. So I think that kind of approach may still continue in the markets on an overall basis is what my broader guess is.
Right, so which are the sectors that will do well from here on? Now, in the recent correction, we have seen a number of stocks headed lower. Some of the sectors have been impacted as well. To your mind, once the markets start recovering, you don't see a big downside. Which are the sectors that will bounce back the fastest?
So I think if you take a corollary that, okay, if the economy also is gradually going to recover, I think on that assumption, I think it leads us to the fact that maybe it's the capital goods and maybe the banking, and private sector banks have really outshone all other banks. So I think it would be the time that PSU banks, maybe couple of down the quarters, would offer phenomenal opportunity to really increase your appreciation of the investments. So I think capital goods, banking appears to be reasonably very well placed. I think they will contribute in the markets going northwards. And apart from the fact that I would still look at pharma and IT to provide a good support to the portfolio.
You spoke about the banks. I wanted to understand what is leading to the optimism here, because we know that the March is a good quarter for banks, but the whole pile of NPAs is really dragging down the performance of banks. And in the last quarter earnings, even private sector banks were not really immune to this NPA problem. We saw the kind of impact that ICICI's earnings and the worries about stress assets had on the stock price. Why are you so positive on the private sector banks? Don't you think the problem of stress asset affects all banks, and is this likely to go away in a hurry?
Sure, I think so far the private sector banks have managed their asset quality pretty well. I think ICICI has taken a bit on the chin in terms of the happening around. Without any doubt, because that bank's focus was also the industry, and they had, and it's almost the second largest bank after SBI. So I think except for ICICI, which has really there has been some issue on the asset quality, the private sector banks have really managed to stay away in a very reasonable way away from all these asset quality problem. So whether they can catch up with the rest of the pack, very much possible if the economy does not improve. So that risk very much remains. In that sense, they are vulnerable. But as what we said, that a lot of things about the worries about the NPAs and all that have been largely reflected in the PSUs and not so much in the private sector banks, bearing ICICI. But if I were to just fast forward a couple of quarters down the line, I think probably over there we will see the recovery happening, and that will get mirrored in the asset quality, and which is where the optimism comes from.
You also spoke about liking capital goods, but if you look at earnings in the last quarter, a majority of the capital good companies disappointed. Look at what happened to BHEL. Larsen & Toubro also wasn't sounding very optimistic. What is leading to the optimism that you have, given that on the ground not much has changed?
So the current issue with both the companies which you named was more of on the execution side. Both of them have a reasonably good order book position at the moment, but the execution continues to be poor because of so many issues. And I think this is where the government is taking it as a top priority to address some of these issues. That is one. And second, I think the overall visibility and clarity in some of these sectors, especially in the infra space, whether it is power or roads or any of those infra related projects, I think they are also gradually emerging on a clear basis. So that will give the confidence. And I think, as what we said, that if all these things, with all what is happening around, with a good government, oil prices falling down, if India has to move ahead in terms of the growth, I think these are the sectors which probably will first have to take the major portion of the orders, and that is where the execution and the visibility can improve. So both the intake of the orders as well as the execution, both hopefully will start improving in the next couple of quarters.
You also said that technology and pharmaceutical companies are the fail-safe. For the last few years, they've had great earnings visibility. But now with the kind of cross-currency headwinds that all these companies face, can they repeat the kind of performance that they've done in the past? For the pharmaceutical companies, we have the US FDA continuing to tighten the screws on any misgivings. Plus, many large cap as well as mid cap IT companies have come up with profit warnings for the impact of currency movements.
Sure, you certainly have a point over there, but the major assumption out over here is whether the headwinds and this volatility is an aberration for say 1 or 2 quarters, or is it going to be a permanent feature? So my own take about this thing is that this volatility doesn't continue always. It happens in spurts, and that is where you get impacted and you could be caught on the wrong side. But the broader call would be and should be that whether the core business is doing pretty well, whether the volume growth is happening, whether the price realization is going to improve. I think those are the broader calls. And of course, how much of EBITDA is getting converted into free cash. I think on all the 3 fronts, nobody has any major arguments against that. And I think whether in terms of ROEs or in terms of free cash, I think all these companies are pretty very well placed. So I would take some of these cross-currency headwinds as aberration, not as a permanent thing which is going to happen. Similarly, even in this pharma companies, I think a few headwinds here and there because the places where they export certainly has got impacted. But on a broader basis, I think overall the direction still seems to be good, whether it's the US markets or whether otherwise. And of course, US markets, we'll keep on seeing some of the observations made by the US FDA on a regular basis. But it still doesn't impact the long-term trend of increasing exports and increasing turnover and the profitability for the companies.
All right. Mr. Bhatt, you mentioned that, from here on when the markets move higher or they stabilize, one has to be a little careful because, in the last 1 year, we saw the markets moving up and a lot of mid caps, small caps, all kind of stocks moved higher. What do you think will be the sectors or the stocks to avoid from here on? Maybe on grounds of higher valuations or maybe on the grounds that growth will not be that good. What would you avoid at this point of time?
So the way the markets are perched at the moment, the way there has been a good run and maybe in a way some indiscriminate rise in some of the mid caps, I think the approach from here on will be that rather than sector specific, I think it will be on a stock specific basis. I think people will still should look at select stocks on a bottoms up approach and slightly on a longer term basis, something which looks a lot more promising on the management bandwidth also. So I think it's not going to be something sector, but I would still focus on the stocks. And within that, for next 6 months at least, I think a majority of the stocks to be concentrated on would be in the front line, in spite and despite the fact that the valuations are not so cheap. So I think the focus will still be out over there. And I think that's where probably some more money has to be made. And gradually, as and when you get confirmation on the recovery, then maybe we can go a little down the line and little broader into the markets.
So Mr. Bhatt, can you suggest some names, some stocks that are looking good? What would you recommend?
So I think in the pharma space, Glenmark looks good. I think Ipca looks pretty interesting. I think still Sun Pharma and Lupin looks pretty good. In the IT space, I would still go for something like an Infosys or something like TCS at the current levels. And in the second rung, maybe something like a KPIT, which probably looks pretty interesting. I think in the private sector banking, maybe I would still go for HDFC Bank, despite the fact of that it's a very richly valued. I think in the banking space, Federal Bank also looks pretty interesting. These are just a few of the names that comes across to my mind.
All right. Thank you, Mr. Bhatt, for speaking with us at NDTV Profit and giving us some stock ideas as well as your feeling about the markets. So, Mr. Bhatt feels that the downside for the market